Tail risk is a very important factor in running a portfolio. It's very important when running risk. So, since the purpose of this podcast is to give people a feel for what it feels like to run a hedge fund, I want to dedicate this episode to tail risk. This is the Not Even Wrong podcast. It's August 23rd, 2020. This is Krim Delco. No updates today. It's Sunday. And let's just jump into it. Using Tesla as a case study, since this is our largest position and the main contributor to our returns, I think tail risk is something that, first of all, has to be defined. It has to be thought about properly, managed properly, and I think it's a key component of the business of running risk. What is tail risk? Tail risk is, the name comes from the bell curve, from the distribution of possible events. The bell curve says that there are certain events which are sort of in the middle of the bell curve, which happen more often and are more frequent, and then the tail is the less frequent events. And the problem with tail risk is that in the hedge fund business, tail risk can have very large impact. So the frequency can be very low, but the impact can be very large. Let me give you an example. We have fires right now in California, and yesterday we thought that we need to go and check the Fremont factory and see how bad the fires are, and if there's a risk that the fires could actually impact the Fremont production of Tesla. So we drove out to Fremont, we saw the factory, we drove around, we took Highway 680, which goes along the factory and along the fires, which are sort of southeast of Fremont, sort of east of San Jose, in that triangle. And we drove all the way up into the national park where the fires actually are. The road, there's a certain road which leads you to the fire, was closed. We then met a ranger, which was there, a very nice lady that gave us a very good rundown on what's going on. Long story short, she told us that the fires are somewhat contained, that the winds are blowing the right direction away from Milpitas, which is the town right next to the fire. And she didn't say that, but for us, importantly, also, the winds are blowing the fires away from the Tesla factory. So this is an example of tail risk in a sense that, listen, when you invest in a company like Tesla, you don't think about the risk of a fire burning down the factory, but it's possible, and it's exactly what a tail risk is. It's a risk that can happen, that can destroy your business, that can make you lose a lot of money. It's not very frequent, but it can happen, and it's worth having that in your head when you think about it. What does that really mean? In terms of managing, my son asked a very interesting question, because me and my partner were talking about this. And then he said, well, can you uninvest and then reinvest once the fires are gone? And, it's a naive question by a 13-year-old, but it's a very important question. Well, the real question in portfolio management is there something I can do here? What can I do? And the answer is there's very little things you can do. You can buy insurance, you can buy puts, you can sell, rebuy, you can do these kinds of things, but to be honest, I don't advise people to do that. We have a very strong conviction that Tesla can become a multi-trillion-dollar company. We don't have a clear path of timing here, so it's not like we know when the stock is high and low and we sell and buy and all that. So we decided to hold on to the stock as long as we believe the upside is still tremendous. And right now, this is one of those times when we think the upside is still tremendous. So what do you do if there's a tail risk like a California wildfire? I don't think there's a lot you can do. I think the best you can do as a fund manager is to run your fund in a way to anticipate a massive drawdown. Drawdown in the lingo of portfolio management means that you can lose a lot of mark-to-market money and still stay in business. This is, I think, the only thing you can do, which means you have to adjust your cost structure in a way that it can sustain large drawdowns, and also your own personal cost structure, assuming that maybe you will not make fees for a while, and therefore you have to be able to sustain your own cost of living in such a way. I think that's the best insurance against tail risk. Trading around tail risk is very difficult. I don't recommend it. There are maybe other people more qualified, real professional traders. I used to be a professional trader when I was on the options desk on Wall Street, but I never considered myself a very successful day trader or anything like that. I am a long-term wealth generation type portfolio manager, and trading is part of it. It's important, but it's certainly not the key to success. So other types of tail risks would be, for example, in the case of Tesla, political risk, China-US trade tensions, which could impact the stock. There are risks on execution, like earthquakes and other types of things, like wildfires, which are natural disasters, which could impact execution. If there is a flood in Austin, it could just take 6 to 12 months longer to build the factory. If there is a thunderstorm in Berlin destroying the water supply to the factory, it could take a couple of months longer. So those are risks that we're fairly comfortable with. But the risk, of course, of a factory burning down, I mean, that's just something that, quite honestly, you can't fathom what that means for the company. I mean, it would be a disaster, and we will ask those questions in the next opportunity we have to talk about how the company is managing certain types of tail risks, such as, for example, wildfires. I assume there are processes in place. For example, a factory like Tesla has to have fire hazard procedures, but it's worth having a conversation and see if the management and the company and the people in charge are thinking about those things. I think COVID was a tail risk, but it wasn't necessarily a direct risk to the company. Like we saw, fortunately, Tesla did very well, actually powered really out of COVID even stronger and relatively stronger to competition. But like things like earthquakes and wildfires, that's hard to imagine that the company can just sustain something like that. Not at this stage. Maybe once they have several factories around the world and also several factories in the US, a certain shutdown, a certain damage of one factory could be stomached. But right now, definitely Tesla is in a position where they can't stomach a very high impact tail risk like a wildfire, for example. So I wanted to just throw out this thought and give a sense for what it means for us to run a fund in the context of tail risk. I think the conclusion is that we as a fund have decided not to trade around those risks, because no matter what we do, it's very hard to do the timing. For example, we spoke with that ranger. The lady gave us really detailed information about the situation, but it's still hard to really guess what exactly will happen, when the fires will stop, if the fires are dangerous enough. So, like I said, I think in the end, the best way to deal with tail risks is to anticipate them, to assume they might happen, and be robust in a sense, in an evolutionary sense. Be robust, which in plain English means survive it. Make sure you have enough stamina, your cost structure is adjusted to the point where you can survive a massive impact. This is the best way to manage tail risks. Thank you.